But when you get all the rules of the game, many things changing at once, basically the regime changes, and that is a different order of magnitude than just pockets of uncertainty scattered around in the economy that are normal. I mean, this is abnormal. So we've had this only two times in the United States. Once with the New Deal and Franklin Delano Roosevelt in the 1930s, and they were changing everything. I mean, the gold clauses were coming out of contracts. It became illegal for Americans to own gold. They were trying to stack the Supreme Court, and put more judges on the court than normal, et cetera, changing all kinds of things, new bureaus, new agencies, new regulations. Now Trump is in the same game, basically, trying to change everything at once. And when you get that regime uncertainty, investors just sit on their hands because they don't know what's going to be happening in the future. And so they stop investing. And we're seeing that in the United States. And you get all kinds of things like companies are not giving earnings guidance now. A lot of companies, which is highly unusual, they say we just don't know where earnings are going. We're not going to make any forecast in terms of guidance. So that's one thing going on. The other thing that's going on is that M&A activity, mergers and acquisitions, that's pretty much dried up because of this regime uncertainty. And then you've got another factor going on, and that is new college graduates in the United States are finding it very difficult to get jobs. And that's because of regime uncertainty, because if a company hires some fresh graduate, the company has to invest a lot of time and money in training them. And that's a form of investing in human capital. And that investment is basically stopped.
Hey everyone, and welcome to another episode of the What the Finance podcast. On today's episode, I have the pleasure of welcoming back to legends, Professor Steve Hanke. So Steve is Professor of Applied Economics and founding co-director of the Institute for Applied Economics, Global Health, and the Study of Business Enterprise at Johns Hopkins University. He's also the co-author of the recently released book, Making Money Work: How to Retire the Rules of the Financial System. So Steve, thanks so much for coming on the podcast again.
Great to be with you, Anthony.
And looking forward to the conversation. Lots happened since we last spoke at the start of the year, but I like to start these interviews very broad. So what are you currently watching in the economy?
Well, two things really. One is what's been going on with the money supply now since, let's say, going way back to April of 2022. The money supply is, the stock of money is right where it was way back in April of 2022. And the rate of growth in the money supply, it's growing, but growing very slowly, still just a little more than 4% per year as a growth rate in the money supply measured by M2. And that's well below my Hanke's golden growth rate, a rate consistent with hitting the Fed's 2% inflation target. That rate is about 6, maybe just a tad over 6%. So we have the stock of money hasn't grown for a long time, and the rate of growth currently is pretty anemic. So that means that we're headed for a slowdown. Now, if you add to that what I call regime uncertainty, which is associated with all the things that Trump is trying to change, and tariffs are obviously a big headline item, the huge international tax. He's always talking about the fact that he doesn't like taxes, but he loves tariffs. Well, tariffs are taxes on international transactions. And if you tax something, you get less of it. So we're going to have a slowdown in international trade and GDP in the United States as a result of tariffs and tariff uncertainty, actually, what I call regime uncertainty. When you get so many things changing all at once, the regime changes and you get uncertainty associated with those changes. So So the 1-2 punch, Anthony, is we've had the economy starting to slow down because of the fact that the money supply a year ago, 2 years ago, 2.5 years ago, was slowing down. And then on top of it, the second punch is all this Trump regime uncertainty. So you put those both in there and you've got a pretty high probability of a recession in the United States. So that's a U.S. economy. China is, by the way, more or less the same, because China is actually in a deflation. The last 4 months in China, the price level has actually been declining and is in negative territory. So they are in a deflation, and the golden growth rate for China is 1% per year, and the money supply is growing at a slower rate than that, about 8% per year. So that's why they have deflation there. So those are the two biggest economies in the world, and I think they're both in trouble.
Yeah, great. Thanks for laying that out. So, can you remind our audience, what are the drivers of money supply that you watch and have sort of dried up in the last 3 years?
Okay, the biggest driver always in every country is the commercial banks. People look at the central banks. They keep their eye on the central banks. They're always talking about monetary policy at the central banks, and they're usually focused on changes in the interest rate controlled by the central bank. But monetary policy is not about interest rates. It's about changes in the money supply. So you have to look at what's changing and driving the money supply, and what dominates and what is the elephant in the room are the commercial banks. They produce, in most cases, around 80% of the money supply is produced privately by commercial banks, not by the central bank. So that's and what is the main component of that? The main component are loans that are made by the commercial banks.
Okay, and I'm guessing the higher interest rates are having an impact of there being, borrowers not wanting to borrow from commercial banks because it costs too much. Is that sort of what we're seeing?
Well, the interest rates do factor in. They do affect the demand, the quantity of loans that are demanded, but it's kind of shall we say, an indirect, not a direct effect. The direct effect are two things. One, what the central bank is doing with its balance sheet, and in the United States right now, one factor that is slowing things down is the Federal Reserve is engaged in what they call quantitative tightening, where they're letting bonds that are on their balance sheet mature and just roll off the balance sheet. So they're shrinking the assets that they own. And when they shrink the asset side of the balance sheet, of course, the liability side shrinks too. And so that's one factor. The other factor happens to be regulations that are placed on banks. And that's the book that Matt Sakurki and I wrote that was released on May 6th, Making Money Work, focuses a lot on the bank regulations, because, again, as I say, banks are the big engine that drive the big changes in the money supply. And if you change bank regulations, which those changes don't happen very often, but when they do, they affect the growth rate of loans and the contribution made by commercial banks to the money supply. By the way, one thing that it looks like it's going to happen, the supplementary liquidity ratio will probably be removed from the banks in the United States, and that will loosen up monetary policy and get the commercial banks more capacity to loan. Now, whether they'll make the loans or not is another issue, because you have a lot of things going on. You have, as you said, well, if you increase interest rates, that reduces the quantity of loans that are demanded. But what if you anticipate that the economy is going to slow down? What if you're faced with regime uncertainty and you don't know what the rules of the game are going to be going forward? You cut back on investment and you cut back on the demand for loans. So you've got a number of things affecting the supply and demand for loans, and the number of loans, the magnitude of the loans that are being generated will affect the growth rate in the money supply, which will eventually affect asset prices and economic activity, nominal GDP, which is composed of the real component and inflation.
Okay, really interesting. So you think they should change the, I guess, banking policies to help with the money supply?
Well, two things that I think they should be doing and focusing on it. One is they should have gotten rid of quantitative tightening at the Federal Reserve some time ago. So that would have allowed for a little bit more rapid rate of growth in the money supply. The other thing is taking these supplementary liquidity ratios off or reserve ratios will also affect things, because it'll loosen up things at the commercial banks and give them more capacity. Whether there'll be the demand there or not, I don't know, but the banks will have more capacity to loan.
Yeah, in our current system, we need, it's a debt-based system. It needs to continually have debt growing for the economy to grow.
Absolutely. The fuel for the engine is the money supply.
Yeah, definitely. And you mentioned at the start that there's sort of quite a lot of uncertainty, and that's having an impact on the economy and markets. And I think we've seen that in terms of, large capex investments. People aren't wanting to make that, so there's potential for M&A as well. I heard a really interesting comparison in one of your interviews. I think I'm not sure if it was with Julia LaRoche, but you comparing it to FDR period, where they were just changing things every single day to try and get the economy going. So do you see there being a similar, I guess, comparison at the moment, where there's just so much uncertainty that companies are not wanting to invest?
Yes, I do. The regime uncertainty we were witnessing in the United States, to qualify, Anthony, you always have pockets of uncertainty all over the place. That's one thing. But when you get all the rules of the game, many things changing at once, basically the regime changes, and that is a different order of magnitude than just pockets of uncertainty scattered around in the economy that are normal. I mean, this is abnormal. So we've had this only two times in the United States. Once with the New Deal and Franklin Delano Roosevelt in the 1930s, and they were changing everything. I mean, the gold clauses were coming out of contracts. It became illegal for Americans to own gold. They were trying to stack the Supreme Court, and put more judges on the court than normal, et cetera, changing all kinds of things. New bureaus, new agencies, new regulations. Now Trump is in the same game, basically, trying to change everything at once. And when you get that regime uncertainty, investors just sit on their hands, because they don't know what's going to be happening in the future. And so they stop investing. And we're seeing that in the United States. And you get all kinds of things, like companies are not giving earnings guidance now. A lot of companies, which is highly unusual, they say we just don't know where earnings are going. We're not going to make any forecast in terms of guidance. So that's one thing going on. The other thing that's going on is that M&A activity, mergers and acquisitions, that's pretty much dried up because of this regime uncertainty. And then you've got another factor going on, and that is new college graduates in the United States are finding it very difficult to get jobs. That's because of regime uncertainty. Because if a company hires some fresh graduate, the company has to invest a lot of time and money in training them. And that's a form of investing in human capital. And that investment is basically stopped. And why? Because of regime uncertainty. If you're uncertain about where things are going, you're not making earnings guidance decisions or announcements. You're not hiring new employees because you don't know whether your investment in those employees is going to actually pay off, because you don't know what the rules of the game are going to be. So that's the regime uncertainty. It starts coming in, and it lays on top of what I think would be a monetary induced slowdown in any case. No matter who the president happens to be, we've had a slowdown in the money supply that's been with us for the last couple of years, and actually more than the last couple of years. And with a lag, that slowdown in the money supply works itself into the economy and slows things down. And then you've got this regime uncertainty thing coming in. And you've got uncertainty about what's happening. We've got two huge war zones that are with us in Ukraine and the Middle East, and threats of war and problems in Asia, especially with Taiwan. So there you have it.
Yeah, thanks for laying that out. It's really interesting. So it sounds like, it's quite a difficult time for the economy. And I know you've been talking about a recession previously. Do you still see that there's a recession on the horizon, or are you already in a recession economically? What are you currently seeing?
I think it's baked in the cake. We're going to see a continued slowdown in the United States, and a very high probability of a recession by the end of the year. And that means that works into the markets, of course, because if you have a slowdown, sales slow down, and margins get squeezed, and profits get squeezed. And given the fact that I think the stock market, the indices are in bubble territory that we haven't seen since the tech bubble in 2001, I think we could be in for a great pullback in the stock markets.
Yeah, so it seems like a perfect storm. Do you think that Trump is going to be able to sort of revolutionize or shift this system, or do you think it will sort of, he's tried a few things and it will go back to normal, or is that something that you're not sure about?
Well, the changes are very hard to make, because and you can see this with the Department of Governmental Efficiency that Elon Musk was the leader of. He identified a lot of so-called waste, fraud, and abuse, said they were going to cut a lot, and it ended up, well, they did a good job of identifying waste, fraud, and abuse, but they didn't really cut very much. So it was the thing is, with the Trump administration, there's a big gap between rhetoric and reality. So there's a lot of rhetoric, and Trump basically fills the airwaves. There's almost nobody else even reported on it. So it's a Trump show. So that's the narrative, that's the rhetoric. But the question is, what's the reality of what actually they're going to be able to do? And that becomes more questionable. And I think the best sign of that is looking at what Musk was able to do with the Department of Governmental Efficiency. And in fact, there was a big gap between rhetoric and reality when it came to the governmental efficiency. And the reason for that, by the way, is that the president is one thing, but he has to deal with the Congress. And once you start cutting things, you've got interest. People have interest, and people benefit from waste, fraud, and abuse. And those people who benefit from waste, fraud, and abuse, they aren't the taxpayers, but they're others, special interest groups, bureaucrats, and so on. And they dig in, and they want to keep their benefits. They want to keep the waste, fraud, and abuse. Musk wanted to get rid of it. There are a lot of people who want to keep it. And I know all about this because I was on President Reagan's Council of Economic Advisors and very involved in what was called the Grace Commission at the time. And the Grace Commission, I identified, I can't remember the exact number, it was like 2,500 things that they should be cutting, eliminating, adjusting, and so forth. And not many of those things ever were implemented. None of those very few of those recommendations were actually implemented because the president would run into Congress. If you want to sell a surplus military base, which I was trying to do and identified and was in charge of, you have a problem because the military base is located in a state, and each state has 2 U.S. senators, and also that base will be certainly located in 1 congressional, maybe 2 congressional districts. So you've got 2 Congress persons. So they're digging in. They don't want to shut them. So that's what you run into.
Yeah, it seems like a challenge. And then I guess all this uncertainty has led the Fed to apparently keep rates stable, but it does seem like they are being far too hawkish for what the current data is showing.
I think they're much too hawkish. And again, hawkish in terms of where is the money supply and how fast is it growing? And it's growing at a slower rate than Hanke's golden growth rate of a little over 6% per year. And it has been for a long time. And that is the underlying feature of where the economy is going, because the money supply changes, and with a long and variable lag, that change in the money supply bleeds into the economy. The money supply is like fuel going into an engine, a gasoline powered engine, and if you lean out the fuel and don't put enough in, the engine isn't going to go very fast. If you put a fuel injector in the engine and rev it up, put a lot of fuel in, the engine's going to move a lot faster. It's a pretty simple idea to get your head around. Unfortunately, the central banks, and this includes not only the Fed but the Bank of England and the European Central Bank, they don't have that view of money. They don't embrace the quantity theory of money. They don't think that there's any reliable link between changes in the money supply and changes in economic activity, which is wrong, but that's the view they have. They're data dependent. They're watching data that are coming in right now. But the problem is that's like looking in the rear view mirror, because those data that they're observing now were determined, the course of those data were determined by what was happening in the money supply a long time ago. If you want to get ahead of the curve and not look in the rearview mirror, you have to look at what's happening in the money supply today, because that will determine what's going to happen with the economic activity tomorrow.
Yeah, and in their recent meeting, Powell was talking about how he's looking at forecasts. So he's forward looking now. So it's interesting how they change depending on what they want to say. And
Well, the big problem with the forecast is the models that they use, because the models are post-Keynesian models that they don't include the money supply. The one thing that the Fed and monetary policy is responsible for is the change in the money supply, but they're not looking at the change in the money supply. It's not in the models.
Yeah, it's definitely a great point. So, Professor Hanke, thank you so much for coming on the podcast today. Really appreciate it. My last question is, what is one message you want people to take away from our conversation?
Keep your eye on the money supply. That's what drives the economy.
Great message. So thanks again. If anyone wanted, sorry.
And by the way, if you want to dig into it and find out about it and how it works, you have to read the book I co-authored with Matt Sekurki called Making Money Work, the one that was released May 6th. It's all in there. We haven't given new life to the quantity theory of money that's been around since the 16th century, but we basically have a new and improved version of the quantity theory of money, and we want to put that at the center of monetary policy, and put commercial banks back at the center of the financial system. Those are the two overriding messages in that book.
Yeah, great. And I'll put the link in the description for the book. If anyone wanted to find out more about your work, where would the best place for that be?
They can follow me on X, where I've got, I think, around 803,000 followers. That's at Steve_Hanke. Or if they want to be included on my weekly distribution list, they just write me an email, Hanke@JHU, and I'll put them on the distribution.
Great. I'll put it in the description below, but thanks so much for your time.
Thank you, Anthony. Have a great weekend.
Hey, everyone. Thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that, but it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right. Thanks again.